Well, hello everyone, and welcome back to another video in this series where we're taking a closer look at the market strength indicator. And I hope you've been able to watch all the earlier videos where we've covered stocks, we've done futures, we've done ETFs, we've also looked at sectors, and really reinforcing the point that the indicator can be used for any instrument in any market and of course in any time frame as well. Now, in this video, we've moved to the bond market, and we're looking at three bonds against the primary index, the S&P 500, where we've got the future. And throughout this whole series of videos, the point I've been trying to get across to you and hopefully plant some ideas in your mind as to how to use the indicator in quite a creative way is to really look at market sentiment, both through the prism of where we expect to see markets in agreement, and also where we see the inverse relationships come about. Clearly, one of those classical ones is very much with stocks and the VIX, which we looked at in an earlier video. And in this one, this is another relationship which has classically an inverse relationship. But one, again, like all correlations, this does tend to break down from time to time for various reasons. So you've always got to be aware of that. So the market strength indicator really embraces a whole spectrum of applications. We start with the very intuitive use where we're looking at overbought and oversold, where we're looking at an instrument or market that's at the top or at the bottom. So we're looking for those opportunities to get into a position early and take advantage, maximize whatever profits available in the trend. So that is certainly one application. A second, of course, is in trends, where we're looking at the steepness of the line. The steeper the line on the chart or the graph rather, then the stronger is the trend. And we've got a classic example of that here. Now we're looking at three time frames. I've got the 5, the 10, the 15. And the green line, this is, I'll just move that over a little bit. The green line is the ES future. So we are looking at an index future there for the S&P 500. And then down below, we have our three bonds. And this is the 2-year, the 5-year, and the 10-year. Now, of course, two things really to say at this point. First of all, you would expect bonds, generally speaking, to move in the same direction. And as you can see across the time frames, that is pretty much what we see. So they will tend to follow one another around. The three colors, the pink, the purple, and the blue, are our three bonds, which are primarily following one another around, although not always. And I'll come over onto the 15-minute in a moment. But if we just stay with the 5-minute for the time being, here you see, and this is on very much an intraday basis, but of course this works on any time frame. You could go out to the dailies, the weeklies, the monthlies. We just happen to be on the slower time frame, on the faster time frames here. Beg your pardon. So what we are seeing here is really a very classical relationship where we have an index which represents equities and risk on, if you like, and we have bonds going in the other direction representing risk off. And you can think of it, the easiest way to think of bonds and equities is in terms of money flow, because if money is moving into the equity markets, it's got to come from somewhere. Generally speaking, it will come from lower risk assets, in inverted commas, such as bonds. So the money flow here on this 5-minute time horizon. And just to frame this conversation, we are currently trading in Globex. It's mid-morning London time. So we are purely on electronic markets here. We are not trading with the cash and electronic running in parallel. So we're just purely looking at electronic markets here. What we are seeing here is the classical shift of sentiment, of shift of money. We're moving intraday out of bonds and we're moving into equities, albeit in a very fast time frame. But that is typically what is going on here. And it's almost perfectly represented here. As I say, we've got the bond markets here falling. Now they're just starting to show a little bit of a kick up here, as you can see, because the index is very much oversold. We're right up at 100 indeed. So the index for equities is very much at an overbought state. and bonds down here are very much oversold. So they are starting to pick up a little bit. And if you think of it in those terms of money flow from lower risk to higher risk, or from higher risk to lower risk, that simply describes this relationship, if you like, very easily. Now, that's not to say this relationship always holds good. It changes from time to time. And one of the most significant aspects that will change it is very much interest rates. So do not expect this relationship to be absolutely cast iron. Like all correlations, as I say, they do break down, and they break down for many reasons. So you have to be aware of that. But understanding this relationship will also give you, as I've tried to explain in these videos, this gives you another dimension, another view, a view on risk, particularly here. Are we in risk on, or are we in risk off? Irrespective of what you're trying to do, whether you're trading indices, whether you're into stocks, day trading stocks, whether you're investing, you're looking at the slower time frames, it just gives you that perspective. Now, what will change, and when we move over to, let's have a look at the 15-minute over here, for example. Yes, broadly speaking, the bonds themselves are following one another around, more or less. And yes, generally speaking, the relationship that I've just described between risk on and risk off in terms of indices and bond markets is typically holding. But from time to time, as you can see here, it does tend to break down. For example, we have our bonds here, which are falling, and we also have our index here, which is falling. And then it re-engages at this point where we see a rollover in the bonds from overbought down into moving into a trend lower, and we see an inflection on the index moving higher. So the relationship is re-established at this point. And the reason for that is really what it comes down to is you have to understand, and this is all fully explained in the stock trading and investing program, of course, in that currently we are in a very strange world where we have raging inflation, or very high inflation, well into double figures, not as a result of a hot economy or hot economies around the globe, but as a result of many other factors, which I'm not going to go into here because it's all explained in the program. As a result of that, if you think of it in terms of a bond, if you are holding a bond which has a set interest rate, a coupon rate, which it will have, and you bought at that price, and then interest rates duly go up, then your bond is worth less. And as interest rates rise, then as bond prices rise, then yields will fall. Now, bond prices will rise purely because as interest rates rise, more bonds will be issued, and therefore your bond price will fall because you are now holding a bond which has, in effect, less value in the market because the interest rate, the coupon rate attached to your bond is less than the market is currently offering, and therefore your bond is worth a little bit less. And that's as a result of more bonds constantly being issued against the increases in interest rates. And that's demonstrably so in the current environment where we are seeing interest rates go up almost on a monthly basis, and therefore new bonds are constantly being issued. So that also interplays in this relationship between equities and bond markets. But I think the easiest way to think of it is very much in the terms I explained earlier, which is money flow. Money is flowing from a risk off asset into a risk on asset, or it is flowing from a risk on asset back into a risk off asset. Because at the end of the day, all money is seeking, and all investors are seeking in the money markets, is higher risk pays higher reward, lower risk pays lower reward. And if the markets are concerned, or if investors are concerned, then money will flow into lower risk assets, such as bonds, although they carry their own risks, again, all covered in the stock trading and investing program. Or alternatively, if risk appetite is high, then money flow will be out of bonds and into equity markets and other risk assets to gain a higher return. And put simply, that is really what you are witnessing here. It is a seesaw, if you like, a seesaw of two risk components, risk on and risk off, which are constantly moving from one to the other. And of course, if you have this on a workspace, this will give you an instant view, whatever you're trading, what is going on in terms of risk. And of course, underpinning all of this, you would be looking at this against volume price analysis. So you would have your bond charts up, your bond price charts up with volume on there as well, because you would see volume. And of course, you have your index future as well with volume there. Our indicators are supportive of the volume price analysis methodology. They do not replace it. They are adjuncts to it. They support it. They give you additional information in this very graphical, very clear, very intuitive way that we can all understand. And it gives us these great turning points, as you can see here, where we're now starting to see the index climb nicely. It's continuing high. We've seen a pause on the 5. Maybe that is going to continue on 10. It certainly is, and over on the 15. And this is an aspect of trend and trend development that we cover a lot and explained in the context of a pebble in a pond. We throw a pebble into the pond, the ripples move outwards. It's exactly the same here. A trend starts in your fastest time frame, 5 minute for us here. If it's going to be a strong trend, it'll go through into 10 and ultimately into 15 as well. And it's all about trend development. And of course, on the chart, we would also have our trend monitor, which would be describing that trend transition for us and confirmation of trend. We'd have our volume price analysis methodology and many other things as well. So I hope you found this an interesting video, not too frightening, where we enter the world of bonds and bond markets. I know a lot of traders and investors get very hung up about the word bonds and find it complex and a little confusing. I hope within the stock trading and investing program, we've taken all that away and explained things very clearly. And I think using this indicator in this way also describes things very clearly as well. And really it takes away a lot of that smoke and mirror stuff and just presents it in this very nice, intuitive way of the relationship that we see, that we expect to see with equity markets. So I hope you've enjoyed this video. Lots more to come as always. So thanks for watching. See you soon and bye for now.